Something unusual is happening in the silver market, and almost nobody in mainstream media is talking about it. Right now, the World Gas Primary Silver Futures Exchange has roughly 103 million ounces of silver registered and available for delivery. At the same time, there are over 400 million ounces worth of open contracts coming due in March. Think of it like this. It's as if 400 people showed up for dinner, but there are only 100 pizzas. The math doesn't work. And with the March delivery window approaching fast, what happens over the next few weeks could reshape silver pricing and possibly broader financial markets for years. This isn't conspiracy, it's public data. Today, we're going to walk through only registered silver matters for delivery. Right now, registered silver sits near 103 million ounces. Total inventory is often reported at over 400 million ounces, but most of that is eligible, not available. That distinction is critical. Since 2020, registered silver inventories have fallen roughly 70%. Nearly 785,000 ounces are leaving COMEX vaults every single day. In January alone, almost 50 million ounces exited. To put that in perspective, 2 years ago, annual withdrawals were under 7 million ounces. Now we're seeing that kind of movement in weeks. This isn't just happening in the US. Shanghai silver inventories are at their lowest since 2016. London Metal Exchange inventories are near historic lows. China has classified silver as a strategic material. The US has done the same. This is global. It's not localized. The chairs are disappearing while the music keeps playing. There's another metric almost nobody talks about, the silver lease rate. This is the interest rate paid to borrow physical silver. Normally, it sits below 0.5%. Right now, it's near 8%. That's massive. When lease rates spike, it means physical metal is hard to find. Borrowers are paying premium interest just to get their hands on silver. Markets don't do that when supply is plentiful. They do it when scarcity appears. This is one of the clearest signals that stress is building beneath the surface. March is a major delivery month. That means contract holders can demand physical silver instead of cash. Right now, open contracts represent roughly 500 million ounces, while registered supply is only about 100 million ounces. If just 10% request delivery, 50 million ounces required, 20% request delivery, vaults effectively empty. The key date is February 27th, first notice day. That's when traders must declare whether they want cash or metal. Recent delivery rates are already near 98%, with over 18 million ounces delivered this month alone. This isn't retail investors. These are hedge funds and institutional players converting paper contracts into real silver. Why? Because paper silver is cheap. Physical silver is scarce. That price gap creates opportunity. There are several possible outcomes. Scenario 1, cash settlement. The exchange can legally force cash instead of metal, but doing so destroys credibility. At that point, it's no longer a silver exchange. It's just a dollar casino. Scenario 2, rule changes. They can raise margin requirements, impose position limits, restrict buying, make delivery harder. They've done all of this before. Scenario 3, paper and physical diverges. Paper prices stay suppressed while physical premiums explode. We're already seeing this in Asia, where physical silver trades far above futures prices. That's what happens when real-world supply meets financial abstraction. This pattern isn't new. In 1980, silver surged toward $50. The exchange changed the rules to sell only. Price collapsed. In 2011, silver approached $49 again. Margin requirements were raised 5 times in 2 weeks. Price crashed nearly 50%. Same playbook. But there's one critical difference today. Back then, vaults were full. Now they're nearly empty. Rules can be changed, margins can be raised, but silver cannot be created out of thin air. Silver has been in structural supply deficit for 5 straight years. Roughly 200 million ounces per year, more demand than supply. Industrial demand is accelerating. Solar panels, electric vehicles, electronics, semiconductors, AI infrastructure. Silver is essential to all of it. About 80% of silver is produced as a byproduct of mining copper, zinc, and lead. You can't just flip a switch and mine more. Even if prices double, new supply takes years. Meanwhile, demand keeps rising. That imbalance doesn't resolve itself quietly. February 27th, how many contracts stand for delivery? Registered inventory levels, especially below 80 million ounces lease rates. Higher means tighter physical supply. Those 3 signals will tell you whether stress is easing or accelerating. This doesn't mean silver goes straight up tomorrow. There may be volatility. There may be rule changes. There may be sharp pullbacks. But the underlying reality is simple. Physical silver is leaving vaults. Industrial demand is rising. Supply is constrained. Paper markets can bend. Physical markets eventually assert themselves. What happens next may not be comfortable, but it will be revealing. Stay alert.